Folks, you better get ready because in today's video, we're going to break down the latest on the market and plays. And then we're going to break down one stock that I believe is the steal of a century and could be a sleeping AI giant. This stock has huge long-term proof of concept, great leadership, major catalysts, and most importantly has the potential to be a center player in the AI arms race. In my mind, there's a massive gap between the real true value of the stock and what it's currently trading at. I believe that it has a lot of potential to be re-rated much higher, and I'm going to make my case for it with the evidence, the data. I'll present all of the receipts, and then you can go off and do your own due diligence and come to your own conclusion. As always, if you're the one taking the ultimate risk, you got to be the one doing the ultimate frisk. Always do your own due diligence and research on all ideas presented. Okay, so let's start with the market. So markets got absolutely nuked on Friday, and we've seen massive reversals over the weekend, but let me lay out the timeline here. So the timeline is as follows. On Thursday, China revealed its most expansive rare earth export controls to date. Friday, President Trump posts about this, says China is trying to assert monopoly control over key rare earth segments, threatens an additional 100% tariffs on China and key controls in certain segments, and then stocks lose some $2 trillion in a single day. Then on Sunday, President Trump writes, "Don't worry about China, Xi just had a bad moment." But then he comes out a few minutes ago and he says, look, 100% tariffs on China are still the plan. But anyways, practically, how does one navigate this kind of volatility as a trader, as an investor, as a beautiful stock market participant? Well, you got to know the playbook, folks, and this is the playbook that we've seen over and over again this year. Step 1, Trump freaks markets out with big threats. Step 2, hedge funds, short sellers, and their media arms cry doom and gloom. Step 3, Trump says we are working on a solution. Everything is fine, buy now. Step 4, markets pump. Step 5, trade deals get worked out in the next 3 to 4 weeks. And step 6, markets go even higher. So this is basically the 6 steps that we've seen happen over and over and over again all year. Now that being said, you might ask, why exactly are these stock market downtrends becoming so severe? How can you see trillions of dollars wiped out in a single day? Well, that's because many participants and whales within this market leverage themselves up to their eyeballs. So any kind of downtrend gets multiplied 2, 3, 4, 5x. Funds get margin calls. They blow up their overall portfolio. Risk management protocols take them out of positions that otherwise they might have wanted to stay in for years. So all of these things combined create this environment where you get these massive liquidity dumps. And I know that that can be scary and you might see big unrealized losses throughout a day, but it's also a huge opportunity because things get way more oversold than they used to. And likewise, probably things get way more overbought than they used to during euphoria cycles. So these are different things to consider. But going back to trade wars and really overall fears, look, the bark tends to be way worse than the bite. The way that I see these trade wars is, quite frankly, they're all a back and forth negotiation tactic, with different countries flexing their different muscles and upsetting markets in the meantime. There's 4 big scenarios that we've seen play out again and again this year. Scenario 1, you have an escalation period and then a de-escalation period shortly after. Scenario 2, you have an escalation period followed by a further escalation period followed by a de-escalation period. Scenario 3, you get an escalation period and then a further escalation period and then a further escalation period and then you get the de-escalation period. Scenario 4, you get an escalation and then you get a de-escalation and then you get a re-escalation. Now, obviously, the more cycles of escalation, the longer the sell-offs can take place and vice versa. The key is understanding that you can't predict the short-term back and forth, but you can take advantage of it. Now, based on Trump's post today, it seems like we are either in scenario 1 where there's a big escalation, but then it quickly de-escalates, but we could also be in scenario 4, which is escalate, then de-escalate, and then all of a sudden there's a new escalation, right? Now, as market participants, you have to understand nobody has a crystal ball and nobody's going to be able to predict a million different variables in regards to the White House, geopolitics, trade wars, so on and so forth. Many folks will destroy themselves every time you have a market sell-off. Many folks will make the wrong action. But the folks that actually succeed over the long run are the ones that actually understand the bigger picture of the long run. If you want to prevail in the stock market, you got to understand that the stock market will always have tons of periods of volatility and panic sell-offs, but in the long run, real value prevails and it climbs that wall of worry. If you look at history, there's always been endless reasons to sell and endless people telling you that you need to sell. But nonetheless, buying and accumulating good assets, especially at dips, has continued to be the best and really easiest winning strategy. So in other words, if this China and Trump truce holds, that's great. Markets can go up faster. If it doesn't and we see a month sell-off, That's great too. That said, I do think that as a result of this whole trade war mishap situation, well, I think you're going to see more and more interest from the White House in backing and or taking stakes in companies in areas where China currently has an edge. Think about this. How can the U.S. allow China to supply such a large percentage of its U.S. rare earths? It's a massive, massive security risk. And obviously, if China wants to, they can chokehold this supply, and all of a sudden we have a massive catastrophe. And this is in many different segments. It's not just in rare earths, but there are other companies and other categories that the White House might be looking at soon. Some of the categories that are pretty obvious to me are critical materials and processing, domestic data centers with top GPUs, specifically from NVIDIA and AMD, magnets and electrification component makers, semiconductor manufacturing and tools, critical software companies, and energy and nuclear, which is a big one, by the way. And we're going to continue showing up here on the YouTube channel and on the Discord to bring you all of these setups that we can possibly find. But at the end of the day, these are the ones that you got to be focused on, because these are the ones that the White House is likely going to be looking to take more stakes in, because again, if they don't support the industries, well, China is just going to have the leg up on us forever, and eventually that might be a catastrophe. Okay, now it's time to get to work on plays. So let's go ahead and start with APLD. So on April 24th, we made a video explaining why data center small cap APLD is a buy, and we've made countless videos on it since then, breaking it down as a buy, and it just hit new highs Friday morning at $39.07. The stock is now within spitting distance of a 10x, which we've long said was a strong possibility. And actually, if you go and you pull up our price target forecast from the Discord that we put out back in June, we broke down the math for this stock getting to $93.30 a share by 2028. Now, this idea was not presented as a gamble. It was presented as an evidence-backed play, and we presented the evidence this whole time. But the company has shown even more evidence in its latest earnings report, and I want to highlight that here for you today. They reported a loss of 3 cents EPS versus expectations of 14 cents EPS, which was a big improvement, showing losses narrowing much faster than analysts expected. They showed revenue surging. Revenues up 41% year over year to $38 million, driven by data center expansion and strong customer demand. CoreWeave contract win. They signed a 15-year, 250 megawatt hosting agreement plus an option for 150 megawatts more. That means that there's long-term revenue visibility locked in there, and there's project acceleration. Construction timelines have been cut from 24 months to 12 to 14 months, meaning faster revenue realization from new sites. You have capital strength. They raised $270 million post-quarter. And of course, I mean AI infrastructure tailwinds. The company is very well positioned to benefit from surging AI compute demand as hyperscalers and startups seek capacity. So anyways, big wins for APLD. Congratulations if you played part of this move and you benefited. But how much longer will data center plays like APLD be relevant? A lot of folks are looking at this and it's gone straight up. So they're like, well, this must be a massive bubble. And of course, look, these stocks will have corrections. Everything does. And it's going to happen. And it's going to hurt a lot of people that don't have an understanding of what these companies are. However, if you look at the bigger picture, data centers are not. They are not overhyped. One thing you got to understand is there's actually a major shortfall, not an oversupply of data centers. There's a massive shortfall, which is why the value of the data centers under construction in the United States is now on track to surpass office buildings for the first time in history. Folks, you got to understand that compute is quickly becoming the world's hottest commodity. And data centers are, of course, a key component of that. Relatively speaking, I mean the amount of data centers in the country, let's say it's right here, well, the demand is like all the way up here. So the idea that data centers are hype garbage is a big stinking joke. Now, moving on to the next stock, HOND. So just the other night, I was watching Jensen Huang, and one of the things that he highlighted was that, look, in many cases, China is behind the US. But when it comes to energy, which is a key component of this AI data center arms race, well, China is way ahead, like leaps and bounds. It's incredibly important that the United States focuses on building out its energy production, specifically in nuclear, because that's where China is really investing heavily. And so anyways, about 2 weeks ago, we broke down why we believe that HOND at $13.95 was a buy, and it was because, quite frankly, its future merger partner, Terrestrial Energy, is a nuclear energy play on a short list for Department of Energy partners. And if you look at its recent trading, it hit $20.55 at highs on Friday, which is great. But what is the continued case to buy HOND stock before they essentially merge and take Terrestrial Energy public? Well, the case that I would make is, for starters, they're a fast to market nuclear. Unlike most sci-fi timeline nuclear startups, Terrestrial's integral molten salt reactor is designed for speed. It's modular, capital light, and using readily available SALU fuel instead of scarce HALEU fuel. And they've already hit major regulatory milestones in the US and Canada. They've got a massive monster TAM, 1.4 trillion. IMSRs aren't just about electricity. They actually deliver 500 585 degrees Celsius industrial heat, which is clean, firm power for data centers, and fuel for green hydrogen/ammonia. This opens a $1.4 trillion addressable market, and OECD economies growing to $1.9 trillion by 2050. They've got competitive costs. Legacy nuclear is very slow, expensive, and single use, but terrestrial promises way more efficient. Numbers: $69 per megawatt hour versus $140 for legacy nuclear. This company also has recurring revenues, not one-off sales. This isn't a sell a reactor and walk away type of model. Terrestrial actually earns from pre-construction, core unit replacements every 7 years, long-term fuel supply and maintenance. That means multi-decade, high-margin revenue streams. And then number 5, you have policy plus partnership tailwinds. Governments in the US, Canada, and the UK have backed them with grants and regulatory progress. Partnerships with Westinghouse, Cameco, Siemens, Texas A&M, and more give them credibility. So anyways, lots of cases for the upside here, but is HOND a good deal? Well, the upside story for HOND is that the potential anticipatory run into combination with Terrestrial Energy Inc. looks like it's going to happen in Q4. And then you have the long-term upside as Terrestrial Energy expands with government/regulatory tailwinds. And then I think that it's likely underpriced, as many people simply don't like to buy SPACs pre-merger. And I know that it's gone up a bit since we said that last time, but I continue to believe that there's a lot more upside here than markets have priced in. And then, of course, downside for HOND, well, the merger date is still pending, and they did get an approval from the SEC, but there's still parts to go through. And then people often like to take profits right before and after mergers, which do cause pretty substantial dumps. And then, of course, SPACs make people worry before mergers, so you can see pretty unpredictable price action. But at the same time, I understand the long-term story here, and I believe that there's a lot of opportunity. Okay, next, we got to talk about PATH, P-A-T-H. So last week I made a video breaking down one of our top ideas that I believed is trading super cheap. UiPath, it was trading at $12.90 at the time, and then it actually ran up to $19.82 a few days later before selling off in Friday's panic. But I believe this is going to age to be yet another dip buying opportunity. Now this is the case that we laid out for Discord members back on October 5th, and this still holds true. PATH has a very opportune setup, as we believe that its market positioning is really undervalued. In both cases A and B, we see it breaking quarters-long resistance and heading towards yearly highs. UiPath is a rapidly emerging leader in enterprise automation, offering a powerful platform that helps businesses streamline operations by automating repetitive, rule-based, and data-heavy tasks. UiPath is used by thousands of companies, from mid-sized businesses to Fortune 500 giants, aiming to reduce costs, boost accuracy, and accelerate digital transformation. You got a great setup here. You got $1.49 billion in revenue. At the time, a $6.85 billion market cap, 82% gross margins, a recurring subscription business, $0 net debt, considering massive cash that overshadows, and OpenAI, NVIDIA, Snowflake, and Google collaborations. You've got a long history here of leveraging AI, and we continue to love UiPath. Okay, lastly, let's talk about one stock that I believe is a great buy right now, and that is Mara, lovely Mara stock, ticker symbol MARA. This is a stock whose revenue is up 64% year over year, net income up 504% year over year, diluted EPS up 355% year over year, net profit margin up 346% year over year, and yet the stock itself is up less than 10% year over year. Now, of course, for years we've been talking about Mara, but Mara is a Bitcoin miner that is aggressively starting to stretch its wings and fly into the beautiful AI data center space, which is great because other players who did this saw huge valuation re-ratings and massive rallitos. Now, the thing is with Mara is that she's one of the largest crypto miners in the game, and their infrastructure and long-term proof of concept is very massive and impressive, which means a huge apparatus to pivot to AI data centering. If you look at their portfolio, they have some 333,000 operational miners across 18 data centers, and so in many ways they are a sleeping giant, and they are starting to wake up. So why is that? Well, they're finally starting to strategically get into the AI data centering business. Our lovely Mara is no longer just a Bitcoin miner, she's quietly building the foundation for a full-scale AI and high-performance computing empire. She operates a 1.1 gigawatt of owned power capacity, only 0.04 cents per kilowatt hour, one of the lowest energy costs in North America. Through her partnership with TAE Power Solutions and recent acquisition of EDF's Exeon, while Mara is creating a flexible grid-based compute infrastructure capable of serving very large-scale AI workloads. And this deal is going to give Mara access to Tier 4 GDPR-compliant data centers in Europe with established enterprise clients like NVIDIA, Deloitte, and 2CRSI. The truth is that I do find the Bitcoin mining segment to be very, very exciting, but it is over a very long-term time horizon where it really starts paying off. And really right now in the present, markets just really, really value AI data centers for many of the reasons that we talked about. And so if Mara can pivot aggressively into that in some shape or form, they don't have to get rid of Bitcoin mining. A lot of the other companies didn't. But if she could pivot into that and diversify into that, well, she could be re-rated much, much higher. I think the strategic European expansion via Exion is a big sticking deal that people aren't talking about. Mara took a 64% stake in this subsidiary, and that's game-changing because it provides entry into European AI markets and government clients and positions Mara as a cross-continental AI infrastructure operator, not just a US-based miner. So in totality, what I see here is the innings of something that could be waking up a massive giant in AI. With Mara, you've got cheap power, global expansion, and early AI infrastructure positioning, making it a stealth AI play at Bitcoin miner multiples, which I think is a beautiful combination. And I think there's a big gap here between where it should be trading at and where it is trading at. If Mara decides to continue growing out their AI data center business like I think they will and repurpose parts of their Bitcoin mining to the highest bidder in the AI space, I think that the valuation of Mara can be re-rated multiple times higher, just like Mara's competitors were. And that's why I'm a big believer in the upside here. Now, at the same time, I got to tell you, we've been big believers in Mara for years, but she has underperformed our expectations. There's lots of cases where we've had stocks that have very, very outperformed our expectations. With Mara, she's underperformed, but I could see a lot of upside potential here. She has a lot of firepower here to pivot aggressively into being one of the best AI data center players out there, while also continuing to keep a lot of her Bitcoin mining infrastructure. I think if you look at the long-term proof of concept with this company, it's got good leadership, it's got a beautiful long-term trajectory, and I would say that it's hard not to see the upside potential here. And quite frankly, after I'm done making this video and it's posted, I'm going to go ahead and alert calls in the Discord for Mara stock with a very specific expiration date to highlight the upside potential over a specific time range that I'm projecting. We're also going to be putting out a new price target forecast for Mara, so some things that I highly recommend looking at if you are in the Discord. If you're not, you can join with that first link down below. Anyways, folks, we appreciate you watching this video. I hope you found value in it. We'll see you in the next one. Let us know your favorite stocks down below, and have a great rest of your weekend.